If you're an American living abroad, the US tax system puts you in a very unique position. You may live overseas, earn money overseas, and even pay taxes overseas to another country, but you are still fully taxable by the United States. In fact, the US is the only major country in the world that taxes citizens based on citizenship rather than residency, which means that the IRS wants its cut no matter where you are in the world. The good news is that the tax code does give expats a few ways to greatly reduce, or in some cases, even eliminate their federal income tax liability. The bad news is that the tax code is extremely complex and often misunderstood by expats. So in this video, we're going to walk through the 3 best benefits for expats that you need to know for the 2026 tax year. Let's dive in. We'll start with the tax benefit that is probably the most widely known for expats, but also the least understood. And of course, we're talking about the Foreign Earned Income Exclusion. For the 2025 tax year filed in 2026, the Foreign Earned Income Exclusion allows qualifying expats to exclude up to $130,000 of foreign earned income from their U.S. federal income tax return. That number is adjusted for inflation every year, and for many expats, it's the single biggest and best tax break that's available. But the first misunderstanding here is that the Foreign Earned Income Exclusion doesn't exempt you from U.S. taxation altogether. It applies only to earned income, which means salaries, wages, bonuses, commissions, and self-employment income earned while living and working abroad. The Foreign Earned Income Exclusion does not apply to passive income, so of course that excludes things like dividends, capital gains, crypto gains, rental income, and pension income. We also have to be clear on who qualifies for this exclusion because a lot of people are really fuzzy on the details. To claim the Foreign Earned Income Exclusion, you must pass one of 2 tests, the physical presence test or the bona fide residence test. The physical presence test is just numbers. You have to be physically present outside the United States for at least 330 full days during any 12-month period. Partial days spent in the US do count as full days, so you have to be really careful about tracking your time spent in the States. The bona fide residence test is a bit more subjective. This looks at whether you have established a long-term presence in a foreign country for that particular tax year. Factors include your visa status, your ties to the local community, and your intent to remain long-term. Choosing the wrong test or failing to properly document your eligibility can result in the IRS disallowing the entire exclusion. We have individual videos for both of these tests, so make sure you check out our tax playlist on the channel. Another critical point is that the Foreign Earned Income Exclusion does not eliminate self-employment tax. If you're self-employed, you will still owe Social Security and Medicare tax unless some kind of totalization agreement applies to your situation. Now let's talk about the Foreign Housing Exclusion, which is closely related to the Foreign Earned Income Exclusion. This benefit exists because the IRS recognizes that housing costs can be much higher in large foreign cities compared to much of the United States. The foreign housing benefit allows qualifying expats to exclude certain housing expenses above a base amount that is tied directly to the Foreign Earned Income Exclusion. For the 2025 tax year, that amount is set at 16% of the Foreign Earned Income Exclusion, which comes out to $20,800. In other words, your housing expenses have to exceed $20,800 before the exclusion begins. Qualifying expenses generally include rent, utilities, parking, and certain other occupancy-related fees. They do not include mortgage principal, home purchase renovations, or luxury improvements. There is also a cap set at 30% of the Foreign Earned Income Exclusion, which is $39,000 for tax year 2025. However, the IRS does publish a list of high-cost localities where higher limits are allowed. If you live in high cost of living places like London, Hong Kong, Singapore, or Zurich, your allowable housing exclusion may be much higher than that general cap, so definitely check out those publications. Finally, let's address the foreign tax credit. The foreign tax credit exists because the US taxes its citizens on worldwide income. However, your host country may also tax your income, which means that without the foreign tax credit, you're getting double taxation. Rather than excluding income, the foreign tax credit gives you a dollar for dollar credit for income taxes paid to a foreign government. In other words, and maybe this is a little easier to remember, you end up paying the highest tax rate between the two countries. Now, one of the biggest advantages of the foreign tax credit is its flexibility. Unused credits can often be carried forward up to 10 years, and that could be significantly valuable if your income fluctuates or if you plan to return to the US sometime in the future. Now, we have full videos breaking down both the foreign tax credit and the foreign earned income exclusion. So again, definitely check out the rest of our tax guide playlist on the channel. We also just released our 2026 Expat Tax Guide, which provides a full written explanation that's free to our email list subscribers, so check that out. Link is in the video description. Don't forget to subscribe to our channel. We're always putting out new tax and finance related content for expats and nomads. Thanks for watching, and we'll see you in the next video.